Hello, and welcome to our latest economic and industry update, once again brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. We tend to start our videos with macroeconomic information, and I like to do so again this time. Gross domestic product, known broadly as GDP, measures how many goods and services a country produces, providing a very quick snapshot of an economy's health. So Jay, what is the US GDP forecast?
Thanks, Mallory. I'm glad to be here once again to provide an economic update. The U.S. GDP rose 2.6% in the third quarter, which beat expectations. And I continue to be cautiously optimistic that although the U.S. economy is slowing, it is returning to normal. The GDP forecast has been revised down from 1.7% to 0.5% in 2022. Now, remember that the past 2 years saw unprecedented consumer demand as well as government stimuli, which has led to significant commodity demands and supply chain hurdles. So it'll take some time to normalize.
I feel like a bit of a broken record here, but inflation continues to make headlines. Headline inflation is the broad measurement that also includes food and energy. It rose in September to 8.2% year over year, but it is down somewhat from June due to lower energy prices. For context, it's helpful to compare headline inflation with core inflation, which strips away food and energy, two main inflation drivers. Jay, how is core inflation faring comparatively?
Mallory, as you said, headline inflation is still high, but it's lower than what we saw in June. Core inflation, which is inflation that excludes food and energy, in September rose over 6% year over year. Now, this was the largest 12-month increase since August of 1982. Shelter, housing, along with medical expenses continue to be the leading causes for the increase. However, since September, though, home prices have begun to fall, primarily due to mortgage rates. And it's estimated that the housing market will continue to slide a little bit in the coming months.
Several times this year, the Federal Reserve has raised interest rates as a way to combat inflation in hopes of supporting a soft economic landing. Jay, do you anticipate any additional interest rate hikes?
Yes, the Fed raised its short-term borrowing rate by 75 basis points at its November meeting. This is the highest level since January of 2008. The Fed is expected to further raise rates into 2023, and it's anticipated that there will be a 50 basis point increase in December. Now, that's only a prediction, though, and the Fed may react differently based on how the economy performs. The unemployment rate for October edged up slightly to 3.7%, but the labor market overall remains very strong going into 2023. Once the unemployment rate is over 4%, we'll start to see significantly lower inflation.
Thanks, Jay. Now I'd like us to transition from the macroeconomy to the rail industry. As we've said before, railcar orders and deliveries are very cyclical, lots of troughs and peaks. Last week, the industry reported third quarter railcar orders, deliveries, and backlog. Nearly 11,000 railcars were delivered in Q3, up about 1,200 units, and orders rose to over 25,000 units due to a large multi-year agreement, growing the backlog to over 61,000 railcars. Jay, please help us put these industry numbers into context. How are railcar loadings and velocity?
Yeah, North American rail volumes have started to inflect positively year over year. Now, this is partially due to easier year-over-year comparisons, but it can also be attributed to improvements within certain commodities such as coal and automotive loadings. This quarter, volumes have risen by 0.5%, but yearly loadings are down about 2%. Now, network velocity continues to be an issue and is currently down about 3.5% for the year, and it's unlikely that velocity will improve much in the near term because railroad headcounts remain well below pre-pandemic levels.
The railcar builder backlogs are fairly varied amongst railcar types, but it is important to monitor how many railcars are being stored and scrapped. Jay, what are the current storage and scrap rates?
The total number of railcars in storage fell to 275,000 units, which is near historic lows and significantly below the long-run average by about 50,000 units. This storage figure represents about 17% of the North American fleet. Railcar retirements continue to outpace new deliveries for the third consecutive year, which is driving new railcar demand. I expect that roughly 50,000 railcars will be scrapped this year.
Labor and material constraints continue to weigh on the industry and are expected to negatively impact rail production. FTR Associates forecasts that just shy of 46,000 railcars will be delivered next year, with freight cars, not tank cars, continuing to dominate the delivery mix. Overall, the rail industry has opportunity for growth as railroads continue to focus on improving velocity and railcar demand remains strong. Any final thoughts, Jay?
Yes, as we progress through this period of economic slowdown and global uncertainty, we remain cautiously optimistic about a soft economic landing through 2023. Now, it's important, though, to remember that the economy is resetting itself from synthetic market stimuli that was experienced during 2020, along with long-term near-zero interest rates. Now, as the economy recalibrates itself, we will see all segments of the economy return to a sustainable level of equilibrium.
Thanks, Jay. And thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.